Hey, YouTube family, welcome to another video show of The Kevin Strong Show. I am your host, Kevin Strong, and in this video, we're going to talk about mortgage problems. There's been some information that came out that says mortgage applications are down almost to a 30-year low. Mortgage payments have gotten so high, they're unaffordable. We're going to talk about that. I'm going to switch over to a YouTube story that talks about this a little bit more in detail. But let me take a moment to say, first of all, sorry about not getting a video out to you guys last week. I know it's important to consistently put content out if you want your channel to grow. So, hey, homie fumbled a little bit, but I'm back. I got the ball back. So welcome if you're new. Start off by saying, hi, Kevin, by smashing that like button. Hit the bell notification so you are notified when I do release my videos, which is typically once a week on average. So what's happening to the mortgage industry? We all have noticed that the Fed has been raising interest rates. They paused briefly, but the 10-year treasury, which is typically tied to the 30-year mortgage rates, is somewhere around 4.6 or 4.7%, maybe a little bit higher. I haven't checked, but it's at an historic level in relationship to where it is now compared to almost 2008. So I don't think the 10-year treasury has been this high since the great financial crisis. So once again, we're getting a reflection point that's not a good data point at all. More and more people have to use a bigger portion of their monthly income to be able to afford a mortgage. I think people need to leave a little room to grow. So what do I mean by that when I say a little room to grow? If you're PITI, which is a standard acronym that we use in the mortgage industry, the P is for principal, the I is for interest, the T is for taxes, and the other I is for insurance. If you have a mortgage payment of $2,500, in my humble opinion, you need to comfortably be able to afford a $3,200 to $3,500 mortgage payment. About 35 to 40% higher than what you qualify for. The reason why I say room to grow, homeowners insurance on a national level is skyrocketing. Property taxes or property tax assessments are skyrocketing on a national level. So what happens a lot of times is that as Americans, we've been brainwashed and marketed by financial institutions to get fixated on payments. It's all about the payment. We don't take into account the property taxes that the previous or the current owner was paying may not be the property taxes that we get hit with after title transfers. So you got to leave some room to grow for unexpected costs that are going to be associated with home ownership. But if you're right at the tip and you can barely afford it, it's probably not a good look. I am a component of saying it's all about the price, not the interest rate. If you buy or overpay, there's not much you can do about that. You can't refinance. And if you really overpay, if you get into a pickle where you need to rent out your place and live somewhere else, your payment is probably higher than the prevailing rent rate. So if market rent rate is at $2,300 and your payment's at $3,600, what's the likelihood of you finding a family that can afford $1,400 higher than what the rent rate is for the area in which your home is at? So you got to be very careful about that. So without further ado, we're going to slide over to this YouTube video that I found that talks about this subject matter a little bit more in detail. And as always, I'm going to offer my editorial comments as we go along. So the first thing here, we're going to talk about this mortgage payment and just kind of putting this mortgage payment in perspective in terms of how high the payments have gotten from a historical perspective.
Now, if you really want to put the monthly mortgage payment amount in perspective, take a look at this chart right here. Never before in the history of the United States has the monthly mortgage amount been this high. Never. This week, mortgage demand dropped to the lowest level since 1996 as interest rates increased. Mortgage applications are now 22% lower than the same week a year ago. As Treasury yields rose earlier this week, mortgage rates followed. In the United States, housing affordability is the worst that it's been since 1984.
Okay, let's take a pause for a cause and talk about this for a little bit. Since 1984, mortgage payments have never been this high. You're hearing this historical bad information. So what makes a reasonable person think that this thing's going to get better before it gets worse? That's why it's really, really important that if you do decide to buy now or need to buy now, it is all about buying at the right price and making sure you have the household income to support that mortgage payment in the long run. You got to look beyond that mortgage payment. You got to look at, what if property taxes go up $5,000, $6,000, $7,000, $8,000 a year? Because that's happening nationally. What if our homeowners insurance goes up 300%? That is happening in certain parts of the country, like in California and Florida. Do you have the disposable income to accommodate those increases? If you do not, you're going to be house poor and might be compelled to have to sell your home just to get from underneath it. And if you bought the home at a bad price, the market's not going to bail you out. You're going to be upside down. You're either going to have to bring some money to the table to get from underneath that mortgage, or you're going to have to give the keys back to the lender. But let's go ahead and continue on this, because I think this is a really, really good YouTube article. I've been following this lady pretty good, and she's really sharp. I like the way she delivers her content.
Likely to happen anytime soon. Here's what he said. To put today's affordability levels in perspective, it would take some combination of up to 28% decline in home prices, a more than 4% reduction in 30-year mortgage rates, or up to a 60% growth in median household incomes to bring home affordability back to its 25-year average. Of course, this is unlikely to happen anytime soon. He predicts that it would.
Okay, so let's recap that. This is what it takes in the current market conditions, notwithstanding a black swan event, no pun intended, but these are the 3 bullet points. Either a 28% decline in housing, which would exceed, from a national standpoint, because this is an aggregate. So if we have a 28% decline nationally in home prices, that would be just as bad or a little bit worse than what it was during the great financial crisis of 2008. Because nationally, I think we're at somewhere around 26 to 27. So it would be on par with the same type of decline that we had back in 2008. A 4% reduction in current interest rates. What's the likelihood of interest rates going down to 4% or 3.75? Highly unlikely. Or a 60% growth in income. Now, this is one person's opinion, but just nibble on those 3 key points. That's how far out of whack the system is in terms of affordability and people being in a position to not only qualify for a home, but more importantly, being able to afford it. Let's go ahead and continue a little bit, and then I'm going to wrap up the video.
Discover strategies to help.
And of course, we get a commercial
on Yield Street, the leading private market investing platform.
We're noticing another alarming trend. Mortgage payments as a percentage of median household income is surging. So household expenses now exceed monthly cash flow. It's just a matter of time until taking on more and more debt, credit card debt for the most part, will stop working for these households that are already struggling. This is precisely why in my latest article on Substack, I made an argument that the American middle class is not just shrinking, it's disappearing right in front of our eyes, as the middle class is not experiencing the same level of quality of life that they once had. This means that the society may be in a transition phase where a couple of decades from now, if not sooner, we may only have 2 extremes, the poor and the rich.
Okay. So once again, that last bit of information that she shared was saying we're at a point now where expenses exceed income. So you're upside down. And this is why you're seeing articles talking about a lot of people are putting putting their grocery expenses on their credit cards because they don't have the income to do it. These are basic necessities. So the pendulum has swung 360 degrees or 180 degrees the other way, right? Before people going out buying, Hellcats and G-Wagons and doing all this dumb shit to try to impress somebody that you don't even know. I did a whole series about 4 or 5 months ago talking about, the car utilization. When you really sit back and think about how many hours a month do I use my car in relationship to the amount of money I have to pay out in order to maintain that car, it's just grossly misrepresented. It's just a bad look in terms of it's a maintenance problem waiting to happen. And it takes a big chunk of your disposable income. But I digress from that. So when you get a situation that we're at now where expenses exceed income, something has to break. And this is why you've also heard within the last couple of years, this famous saying, you'll own nothing and like it. Because when they do this rug pull, eventually, which is possibly going to happen, there's going to be very few people that's going to be able to take advantage of some of these discounts. So once again, it's incumbent upon you to do your own market research, know your market. If you do decide to buy, that's great. Make sure you're not overpaying for the property. Make sure that you have enough disposable income to accommodate unexpected expenses, to include having an emergency fund, and also make sure that you are reasonably comfortable, not delusional, not cognitive dissonance, reasonably comfortable that you are going to have a job. Because we all know wages are not keeping up with inflation. Even though they like to tell us it's kind of like on par or inflation's at 3.7%, nobody believes that. We all know inflation is much higher than that, and we all know that income is not keeping up with inflation. So what are you going to do when the system comes for you? I leave you with my famous quote: keep your credit score up and your debt down. Please like and subscribe to the channel. Hit that bell notification. And once again, I do thank you for spending some time with me and viewing my video. And I look forward to seeing you in my next one. This was the Kevin Strong Show. Make it a great day.